So you're looking to get a smarter take on the market, right? To kind of understand the underlying rhythms without getting totally lost in the day-to-day noise.
Exactly. That's a great way to put it.
Well, that's what we're aiming for here. Today, we're diving into something pretty captivating.
Yeah.
Seasonal stock market trends.
Mm-hmm.
We've gone through, well, a lot of material, mainly drawing from decades of data presented in seasonal stock market trends, looking for those patterns that just keep showing up.
Yeah, the recurring ones.
Our mission today, pretty simple, really. We want to pull out the most compelling of these trends and explore what they might mean for you as an investor. And crucially, we're sticking only to the info in these sources.
It's really interesting stuff, isn't it? This whole idea that the market, which can seem so random, might actually have these predictable ebbs and flows.
Yeah.
And really, at its core, looking at seasonality touches on something, well, fundamental.
Cycles.
Cycles, right? We see
Yes.
them everywhere. We do. In nature, in life,
Mhm.
and human behavior, which really drives the financial markets, is no different. You could almost say the stock market is the ultimate barometer for our collective feelings about money.
Okay, hang on. Let's unpack that. So you're saying our collective moods, swinging from optimistic greed to fear and back again,
Right.
isn't just chaos, but it has a kind of rhythm the market picks up on.
That's the idea. We all try to be rational with investing, of course.
Sure.
But let's be honest, emotion plays a huge role. And these shifts in investor feeling, well, they often seem to line up with broader seasonal patterns, influencing when people feel more like buying or selling.
That does make a certain intuitive sense. But, okay, before we get ahead of ourselves and think we found some magic market formula,
Yes, exactly.
we need a big caveat here, don't we?
Absolutely crucial. Seasonality is, think of it as a lens, maybe, not a crystal ball. We are definitely not suggesting anyone build their entire investment plan just on these historical trends. It's more like another layer of information, something to be aware of, as part of a bigger picture. And the sources themselves are very clear. Past performance, even if it looks impressive, is absolutely no guarantee of future results. That's the bedrock disclaimer here.
Got it. Important perspective. So with that firmly in mind, let's get into some specifics. What patterns do our sources highlight? Let's start with the monthly stuff, this turn of the month idea.
Right, the turn of the month. It's quite remarkable, actually. Norman Fosbach's research pointed this out. A historically strong period, usually around the very end of one month and the start of the next. Specifically, the last trading day of the month and then the first 4 trading days of the new month. So a 5-day window.
Interesting. And what's the thinking behind that? Why would that little window be consistently strong?
Well, the main theory revolves around regular money flow. Think about paychecks.
Mm-hmm.
Many people get paid near the end of the month and often have automatic investments set up for retirement accounts, mutual funds.
Right. 401ks and stuff.
Exactly. So there's this influx of cash hitting the funds, and the fund managers then need to put that money to work, often buying stocks right at the beginning of the next month.
Which creates buying pressure.
Precisely. It can push prices up, at least temporarily.
And the data.
Yeah.
It seems to really support this, doesn't it? Our sources show that over the last 100 years or so, the last trading day of the month was the 3rd best performing day overall.
That's right. Only beaten by the 2nd and 3rd trading days of the following month.
Wow. And there's a chart, figure 4.7, showing if you put $1,000 in back in 1900 and only invested it during the last 2 trading days of each month.
Yeah.
It grew into a surprisingly big number.
It did. And it's not just the size of the return. Look at figure 4.8 that shows the 10-year rolling return for this strategy. It highlights a fair degree of consistency.
Mm-hmm.
Even when there were down periods, they were often followed by strong bounces back. It suggests some underlying resilience in this pattern. You could almost wonder if all those automatic investments make it sort of self-perpetuating,
A predictable little wave each month. Okay, so if those are the good days, what about the flip side? The sources talk about the worst trading days of the month.
Yes. And you definitely wouldn't want to be parked there consistently. Figure 4.9 shows what happens if you only invested on those specific worst days.
Let me guess. Not pretty.
Not pretty at all. A significant loss over the long haul. It's a really stark contrast when you flip it and look at figure 4.10.
Which shows
the growth from investing only on the non-worst days. Basically, avoiding those few bad days made a huge difference. The cumulative performance gap is just massive.
that really drives home how timing, even just avoiding certain windows, can matter. Okay, let's shift from the monthly rhythm to something else. Holidays. I feel like I've heard chatter about markets being cheerful around holidays.
That's another classic seasonal observation. Norman Fosbeck noticed this too, that the market tends to do better than average on the trading days leading up to major holidays.
Okay.
And Martin Zweig also did a lot of work analyzing performance both before and after holidays.
And what did they find? What's the core takeaway?
Well, the data shows a significantly higher annualized return for the 3 trading days before and the 3 trading days after each holiday compared to all the other trading days.
A noticeable lift.
Yeah, a surprisingly consistent one.
But the sources point out, you can't just trade these few days around holidays and call it a strategy, right? There aren't enough of them.
That's the limitation, exactly. The annualized return looks good, but because you're only invested for a small number of days each year, the total cumulative return isn't really enough to stand on its own.
Right.
But it's definitely another factor, something that could potentially nudge returns if you combine it with other things. And there's even a list, Table 3.4, the top 24 holiday trading days.
Oh, yeah. Like which ones?
It highlights specific days like the 3rd day before New Year's, the 3rd day after Christmas, the day before Independence Day. Those days have shown the best cumulative results historically.
Huh. And there's even mention of an ultimate holiday system, UHTS. Sounds a bit punchy.
It is. That involves using leverage borrowing to invest specifically on the day before holidays.
Ah, so amplifying things. More risk, more potential reward.
Precisely. It's framed as a more aggressive approach for those comfortable with that extra risk.
Okay, let's pivot again. Another big one people talk about, almost like market folklore, is the January barometer.
Ah, yes, the January barometer,
Yeah.
very widely followed. The basic idea is simple. How the market does in January might give you a clue about how it'll do for the rest of the year.
As goes January, so goes the year.
That's the saying. And there are a couple of interesting twists on it, like the first 5 days indicator and the last 5 days indicator.
Okay, how do those work? What's the signal?
Well, the first 5 days one is pretty straightforward. If the market is up overall in the first 5 trading days of January, the signal is positive for the year ahead. If it's down, the signal is cautious.
Simple enough.
And the last 5 days works the same way, just using the performance of the final 5 trading days in January as a potential guide for February through December. There's a chart, figure 2.1, that shows the growth using the first 5-day strategy since 1937. It's pretty compelling visually.
And there is a January barometer. Sounds like it combines things.
It does, exactly. It's more nuanced. It looks at the whole month of January, plus the first 5 days, plus the last 5 days.
Okay.
And it gives a score from 0 to 3 based on how many of those 3 periods were positive.
And what does the score tell you?
Well, Table 2.1 shows how those scores have historically linked to market performance for the rest of the year, from February to December. For instance, getting a score of 2 or 3 has historically led to much higher average gains for the rest of the year.
So looking at those 3 January pieces together gives a more layered signal for the year ahead. That's quite clever.
It's another potential piece of the puzzle, yeah. Trying to synthesize those early signals.
Okay, let's zoom out now. Beyond months or the start of the year, what about longer patterns, like within a decade? The sources talk about decennial patterns.
Right, decennial. This looks at market performance based on which year it is within a decade.
Right.
Year 0, year 1, year 2, all the way to year 9.
And Table 5.1 breaks this down.
Yes, it shows the average annual return for each year number across multiple decades. And some interesting tendencies pop out.
Like what? What are the main trends over a decade?
Generally speaking, the early years of a decade, especially years ending in 0, 1, and 2, tend to be weaker on average.
Okay, a slow start.
Kind of.
Right.
And then the later years, particularly those ending in 5, 8, and 9, have historically shown more strength.
A stronger finish.
Exactly. And there's also this specific period called mid-decade rally.
When's that?
Typically runs from the end of September in the year ending in 4 through to the end of March in the year ending in 6. Table 5.8 shows the average gain for that specific window.
Huh. So even where we are within a decade might historically have some bearing on returns.
That's what the historical data suggests. Being aware of these longer cycles might help frame expectations, maybe influence strategy timing a bit.
Okay, now for maybe the most famous one of all, sell in May and go away. Everyone's heard that phrase.
It's certainly one of the best-known seasonal adages. It really gained prominence around the 1950s.
And the core idea.
It's based on the observation that the stock market, historically, has performed significantly better during the 6-month stretch from the first trading day of November through to the third trading day of the following May.
Okay, the winter-spring months.
Right, compared to the other 6 months, basically May through October.
And this isn't just a myth. The numbers actually show this difference.
Oh, yeah. For something like 60 years, that November to May period has pretty consistently beaten the May to October period. It's a remarkably persistent pattern.
Wow. Now, the sources also mention using an indicator, the MACD, to potentially refine this. How does that fit in?
Right. The Mazy moving average convergence divergence. It's a momentum indicator. Think of it like trying to gauge the market's current speed and direction.
Okay.
So the idea is, instead of just blindly selling on a fixed date in May and buying back in November, you use the MACD signals to potentially get in a bit earlier or stay in a bit longer based on the market's momentum at the time.
Trying to time it a little better using momentum.
Exactly. Gerald Appel's work was key here, and the Hirsch organization refined it. Figure 8.11 shows how applying this MACD filter to the NASDAQ, for example, significantly boosted the profitability compared to just the basic sell in May rule.
So adding that momentum check helps make the seasonal rule a bit more dynamic.
That's the goal, yes, making it more adaptive to what the market's actually doing.
Okay, so if May to October is historically weaker, what about the summer months specifically? June, July, August, are they the main drag?
It's interesting. The first half of the 20th century actually saw strong summers, but that seemed to flip around 1965.
Really?
Yeah. Table 8.6 shows that since then, the summer months overall have been, well, kind of a lousy place to be invested on average.
So much for the summer rally myth, then.
Well, there is something called the mini summer rally, usually around the 4th of July.
Ah.
It covers the last 3 trading days of June plus the first 9 of July. It has provided some temporary boosts, but the sources say its performance has been pretty streaky, not super reliable year after year.
So a potential short-term blip, but the overall summer trend since the 60s hasn't been great.
That seems to be the takeaway from the longer-term data, yes.
And then that brings us to the fall, September and October. These guys have a bit of a reputation, don't they?
They certainly do. September, historically, is the absolute worst performing month of the year.
The worst.
Yep. Figure 8.17 shows the pretty dismal growth if you'd only invested in September over the long run. The average daily gain for September is actually negative.
Ouch, okay. And October, known for volatility.
Exactly. October has seen its share of crashes and sharp downturns. It's historically been a volatile month. And interestingly, Octobers in years ending in a 7, those have been particularly weak. Table 8.9 and figure 8.18 highlight that specific vulnerability.
Years ending in 7. Interesting. So September and October are months where history suggests maybe dialing back risk a bit, or at least being more cautious.
That would certainly align with the long-term patterns, yes.
Now, the sources also mention something a bit different, these longer-term fixed-length cycles, like
Yeah.
a 212-week cycle. People are sometimes skeptical about these, right? Because the why isn't always obvious.
That's true. There's definitely skepticism. These fixed cycles, like the 212-week one, which is roughly 4 years, or the 40-week, about 9 months, or even a 53-day cycle, they don't always have a clear economic reason behind them. But the historical track record for some of them is quite intriguing. Take that 212-week cycle. Figure 6.1 shows what happened if you invested for 6 months, starting after each cycle date, going back to 1937.
Oh.
It shows remarkable consistency in capturing gains and, maybe more importantly, avoiding a lot of the major bear markets.
So even if we don't fully get why it works, the historical, what the actual pattern might still be useful information.
That's the argument. Maybe not something to base everything on, but certainly another piece of the puzzle, another riddle to be aware of, especially for longer-term timing or risk management.
Okay, wow. We've covered a lot of ground. Monthly effects, holidays, January, decades, sell in May, summer, fall, these longer cycles. How does an investor possibly wrap their head around all this and use it?
That's the challenge, right? Synthesizing it all. And that's where the sources introduce something called the Key Trend Indicator, or KTI.
KTI?
Yeah.
What's that?
It's basically a way to combine a bunch of these different seasonal trends into one single indicator. It looks at whether several key patterns are currently signaling favorable or unfavorable conditions.
A composite score, kind of.
Exactly. It gives you a broader seasonal reading based on multiple factors at once.
And how does this KTI measure up against actual market performance historically?
Well, Table 9.2 shows the performance of the Dow Jones based on different KTI readings. And there's a pretty clear correlation.
Higher KTI means.
Higher KTI readings generally lined up with better market performance, more up days, higher annualized returns. And conversely, low or negative KTI readings were often associated with weaker, more bearish market periods.
And the sources even propose some hypothetical trading models based on this KTI.
They did. 3 models. A simple long-only strategy, a long-only plus leverage, LOPL, and then a combined long-short strategy, also with leverage, called JUSB.
And how do they do, hypothetically?
Hypothetically, they showed significant outperformance compared to just buying and holding, especially that JUSB model over the very long term. The growth shown was quite dramatic.
But there's always a but, right?
Always. It's crucial to note these models still had drawdowns, sometimes significant ones.
Needing losing streaks.
Yes, which really highlights the psychological challenge. You need a long-term mindset and the discipline to stick with the system even when it's going through a rough patch. That's often the hardest part.
So the KTI offers a way to integrate these seasonal factors, but it's not a smooth ride guaranteed.
Definitely not. It's a framework for potentially harnessing these tendencies, but markets are still markets. Volatility and drawdowns are part of the game.
Okay. Well, this has been a really thorough exploration, fascinating stuff. Let's try to pull it all together. What are the absolute key takeaways from all this seasonal trend research?
I'd say the big ones that really stand out from the data are that turn-of-the-month effect seems quite persistent. The benefit of simply avoiding the historically worst trading days is significant. The holiday effect, while maybe not a standalone strategy, is statistically noticeable. The January barometer and its variations offer intriguing predictive hints. Those decennial patterns, weak starts, strong finishes to decades.
Got it.
The classic sell in May rule holds up surprisingly well over long periods. And finally, the historical data clearly shows September and October as generally weaker, more volatile months.
That's a great summary. So for you listening, as you process all this, what's maybe one actionable thought to take away?
I'd encourage you to just think about how these historical tendencies might or might not fit with your own investment timeline and how comfortable you are with risk.
Yeah.
Could being aware of these patterns subtly influence some of your decisions, or maybe just prompt you to look deeper into one or two that seem particularly relevant to you? It's food for thought.
Definitely. And maybe one last provocative thought to leave you with. Are these patterns, these decades-long seasonal trends, just self-fulfilling prophecies? Do they happen just because enough investors believe they'll happen and act accordingly?
The behavioral finance question?
Or are there deeper, maybe not fully understood economic or even psychological drivers behind these rhythms? As we've said, past performance isn't a guarantee.
Never is.
But the consistency over such long periods,
Yeah.
it really does make you think, doesn't it? Suggests there's something worth paying attention to, worth thinking critically about. Maybe mull over those underlying factors, the psychology, the institutional flows that might keep these market heartbeats going.
A fascinating puzzle to keep observing.
Indeed. Thanks for joining us on this deep dive.